7 years ago, I started a journey across the globe with my team from WSBI. Our goal was to help our 12-member countries in Africa, Asia, and Latin America double the number of savings accounts for the poor. Along the way, we found a world of experiences.
Okay, tell me about it then.
Well, the banks participating in the WSBI program faced very different environments in terms of unbanked potential and levels of poverty. But there were also many common factors. Our first conclusion was that the poor and near poor always dominate the unbanked market potential.
Wait, what do you mean by poor, near poor, and market potential?
Well, by studying the various markets we were working in, we came to realize, for example, that in Tanzania, poor or near poor people involve 60% of the population. Whereas in Morocco, only about 20% of the population is situated in this segment.
I see. So in Tanzania, poor unbanked people could, in fact, be considered as the mass middle market, whereas in Morocco, the mass middle market is mainly unbanked people that are only moderately poor?
Exactly.
But does this cover the whole story? Who's actually unbanked?
We learned that in Burkina Faso, Kenya, Uganda, and Tanzania, the biggest group of unbanked people are the heads of the households and the young people living in those same households.
And how is the situation in better-off countries like El Salvador, Indonesia, and South Africa?
In these countries, there are fewer unbanked household heads, but the number of unbanked young people living in households is equally high, if not higher.
So we can conclude that these different environments call for very different approaches. And secondly, that young people deserve special attention because there are so many out there.
As we continued to study our project countries, we came to understand that population profiles and their spending power define how much people can afford to pay for their financial services, and that there is not only a difference between countries, but also between urban and rural areas in cash flow. In poorer countries such as Uganda or Tanzania, being poor can mean living on about 75 cents per day, whereas in better-off countries, it means having between $2 or $3 a day.
So what does that mean for us in terms of the price of a savings product?
Very good question. Let me give you an example. Imagine James. He lives in rural Tanzania and has roughly $1.25 to spend each day. The amount of money that he can pass through his financial service providers, covering all of his savings activity, loan repayments, plus a remittance payment to his uncle, is limited to no more than $25 per month. James spends about 4% of this, or roughly $1 on transaction and withdrawal fees, balance inquiries, and so on. That's the equivalent of what he has to live on for one whole day.
I see. So how do we define the pricing of a bundle of transactions within what someone like James can afford?
That's the second conclusion. We call the maximum available amount the affordability envelope. And the real challenge is to cover the cost of around 5 transactions per month within this envelope. This envelope is larger in better-off countries, but the challenge remains the same for every possible country. In James's case, he can afford to spend $1 a month on his financial transactions. But don't forget that for many people of our target group, an amount like this has to be shared with other providers as well, such as mobile network operators and informal services. Poor people, after all, tend to use a mix of these services. So in reality, we have to think in terms of probably only about 60 cents.
Goodness. And what about us? We have to cover the costs of our distribution network. How do we fit our resources to what the market can afford?
To answer that question, we need to consider the number of customers and catchment areas that different types of outlets need in order to be sustainable. Branches and mobile vans need around 9,000 customers living in an area involving about 50 to 100,000 people, depending on the level of competition that exists. A kiosk with a single teller works in smaller towns with a population of about 10,000 people and 2,000 customers. Agent models work in rural centers with populations of as little as 5,000 people and 700 customers. But that brings us to an underlying challenge.
How to reach out to rural communities?
Well, that's my third conclusion. Without partnerships with mobile network operators, it will be very difficult to reach out to rural communities, which is where most of the people live, especially in Africa and Asia. Taking East Africa as an example, we have performed geospatial analysis of cities, towns, and other communities, which have allowed us to really see how people cluster, and moreover, how many locations there are with our target populations. It really came as a surprise to us how quickly settlement density falls below the level needed, namely 5,000 people living within 2 kilometers of a possible agent location.
So are you saying that in countries with dispersed rural populations, there is no sustainable own agent solution to reach the rural poor?
In essence, no. In Kenya, the cutoff point where population clusters are too dispersed to operate a bank agency in a sustainable way is set at 1,000 locations. That represents about half of the total population of Kenya. In Tanzania, the situation is even more challenging. There, the cutoff point is set at 200 to 300 locations, and that represents only a quarter of the whole population. We found that parts of rural Vietnam look very similar, and the same goes for Indonesia. On the other hand, mobile money services reach farther out because people will easily walk 5 kilometers to pick up money or send a transfer that is typically the equivalent of 1 week's living, whereas they will only walk 2 kilometers to put a spare dollar into a savings account.
So what does all this mean for banks?
It means that the only way to reach more than a quarter of the unbanked population that live in very rural areas is to pay mobile network operators to collect rural deposits for us and not to charge the customer for their savings transactions. In peri-urban areas, 60 cents a month will cover the cost of the computer systems plus 5 minutes of the time of the teller. That is, as we said earlier, the exact amount in bank charges that people in poorer countries can afford to pay. This should be enough for 2 to 3 counter operations per month.
But what can a bank do to encourage sufficient take-up in activity, to make this idea profitable from a business case perspective?
Well, in some countries, we've seen indications that by taking calculated risks with very low pricing, it is possible to stimulate a high-volume take-up in activity. That is because the demand curve for people at the bottom of the pyramid is very elastic, not far off horizontal.
So in other words, they really want the service, but only at the very low price they can afford.
Yes, but that doesn't alter the fact that we still have to cope with our supply side costs. There's no way around it, and we need to face some fundamental questions. What can we do with our existing network? How do agent networks help? And what role should mobile network operators play within a bank's channel mix?
I guess you must have an active customer base of, let's say, 1 million or more customers for a sustainable solution.
Absolutely. That is indeed our calculation. Lower prices, new technology, and more customer-centric approaches will help us to overcome inactivity. That's a huge elephant in the room across all banking sectors in lower and middle-income countries.
Isn't lowering transaction prices also going to help bring activity back into existing outlets?
Yes, indeed. Some banks have become so inactive that they offer a huge opportunity for us because an underemployed branch teller is really off the scale in terms of costs. However, single teller outlets processing 1 transaction every 2 minutes could cost the same as agents. But if we paid a mobile network operator around 10 to 15 cents for a remote cash-in and cash-out service, this would even be cheaper.
So if I understand all this correctly, this means that if we become more digital and team up with mobile network operators, we'll be able to lower the cost of cash-in and cash-out services in remote rural areas. In urban areas, we can achieve low-cost cash-in and cash-out services if we just start using the capacity of our branches and agent networks in a better way. Whether the equation works or not in a sustainable way depends on the volume of the active customer base.
Yes, that's indeed the last conclusion.
But is simply lowering our prices going to be enough to make our customer base more active?
I think the key words are customer centricity. Remember when we first started becoming aware of the needs of the poor and developed our needs bubbles?
Sure, I remember. It helped us understand that the most immediate need of poor people is to make payments and that savings come later.
Another route to customer centricity is to get to the bottom of customer preferences through data analysis. Customer transaction data tell us a great deal about their financial behavior, which we can then use to tailor individual messages to different segments of the customer base.
I do see that technology helps us a lot to better understand our customers, but in a more digital world with fewer face-to-face contacts with our customers, how can we still understand what motivates them emotionally?
Oh, that's not so difficult. In Kenya, we conducted focus groups which revealed that young people in particular are very creative and open-minded in helping to co-create new solutions. Financial diary research also helps us to understand how people manage their money. One thing that we've discovered is that most cash does not leave the villages.
So that's how you identified the huge potential of banking village groups to bring banking to deep rural areas and provide a safe place to save for millions of group members?
Yes, my friend. We even started using Bluetooth technology to further drive down costs for people in remote villages. Affordable banking for the bottom of the pyramid in remote areas. That's how we'll make it work.
Okay, so as I see it, the challenges that we all are facing are the following. First, we need to better understand who the unbanked really are, what their financial needs are, and how much they can afford to pay to meet those needs. Second, we need to get a realistic fix on how much people can afford to pay for their financial services, and work out how we can stretch the services that we offer within that amount. Next, we have to work out the mathematics of what services we can offer, and beyond that, look for partnerships with other providers so that it becomes less costly to pay them to provide parts of the service package. And finally, we need to develop really smart business models that encourage customers to actually transact with us rather than open accounts and then lose interest.
You've got it. Microsaving is easier said than done. We've crossed many borders over the past 7 years, and there's no doubt that there are still many more to come.